Hey, Bowtie Nation, Joseph Hogue here. Welcome to another Sunday live stream, another Beer Money Sunday. I got mine. Hope you got yours wherever you're at in the world. See a lot of OGs of the Bowtie Nation there, longtime citizens. They're in the chat. Belgium, New York City, Hollywood, Florida. Thanks for being here. Thanks for joining me. I love doing these every Sunday just to kind of connect with you out in their community a little bit closer and answer your questions and really talk about something, what's going on in the market. I want to specifically call out and appreciate a few of you citizens in the Bowtie Nation. Actually added some moderators to the channel this last week. Some long-time members of the nation. They're going to help us, cut down on some of the spam, some of the scams in the comments on the videos, and maybe even, moderate some of the spammy kind of stuff that we get here in the chat in the live streams every once in a while. So thank you to all you out there. Robert, Karthik, I know signed up. I haven't gotten to adding moderators for all of the people that signed up on the Facebook channel over the last week, but I'm gonna get to you. I'm gonna add you as a moderator, and it's gonna help make things run a little bit more smoothly here. But so thank you for your help specifically to you guys out there in the Bowtie Nation. Again, great being here. Love doing this every Sunday. Just kind of an informal, relaxing time. I can take off my bow tie and just talk to you out there in the nation. Got a great video for you this week. Going to be sharing really what's the single biggest chart, the single favorite chart in my favorite research resource that I like using. And it's going to show you how to invest for the highest returns. Where Wall Street analysts and professionals see the highest returns in the market over the next year. And not only is it going to kind of guide you in that direction, but it's also going to, help you build your own narrative, your own story behind where's the market going, where do you see it going, and make you a better investor there. So we're going to get started right away because we got a lot to cover today, and I want to get to your questions and answers, questions at the end of that topic. But I do want to point out, as I always do, pinned in the comment in the chat above, and they'll be in the description below, a link to our Bowtie daily Bowtie newsletter. Goes out every night, 9 p.m. before the market opens the next day. Going to give you all the important news, the trends, and the strategies for investing. So check that out. Click through. It's free to sign up. I'll never ask you to pay anything for that newsletter. Just something I like to do, kind of connect with you out there through email rather than through video and what we do here on YouTube. But let's get started because we've got a lot of stuff to talk about. If you didn't catch our videos last week, had reopening stocks on Monday, which is hugely important right now. A lot of these already up 60, 70% over the last couple of months, but really could be a lot further to go on a lot of these stocks. But I think you got to be careful. We covered some of the industries and some of the sectors that I'm watching in that reopening theme on Monday's video. And a lot of people were kind of surprised that I avoided the cruise lines and the airlines. And I kind of laid out why that is, why I think those maybe have run too far for some of their fundamentals, but gave you 3 stocks to watch, in that reopening theme, as well as some of the other industries that I think could outperform. Did a tech penny stocks video on Wednesday that's going really well. A lot of people are really liking that one. Just some of the new tech themes that I'm watching, but in penny stock company sizes that could do very well. Next week, got some great videos coming to you. Going to cover space exploration stocks tomorrow on Monday, and this is part of our ARK Invest Big Ideas theme, right? So, over the past couple of weeks, been taking the ARK Invest Big Ideas research report, 112 pages of research on the 15 themes that Kathy Wood and all the analysts over there at ARK are following. And for the stocks that you need to be in over the next 10 or 20 years, these huge themes that are really guiding the market. The problem is the research report doesn't really talk much about the individual stocks. It gives you the research, and it's great research, but it really doesn't cover what specifically to invest in. So I'm taking each one of those 15 themes. I'm going to share that research with you, show you what that's all about, and then actually give you the stocks that you need to be watching in each of those themes. So space exploration, going to cover that tomorrow, and it'll be a really great video for you there. But I want to get into this stock chart that I'm watching, and I see a lot of comments, a lot happening in the chat. Thank you for being here again. Love doing these Sunday live streams. But what I'm going to do here is switch it over to show you my screen and show you really how to find this. And those of you out there in the nation, you know, FactSet Earnings Insight is really my favorite research tool to use for following the market. And it's completely free. You can find some great research put out every week, every 2 weeks by the people over at FactSet. And this particular one, you just go to Google, type in FactSet Earnings Insight, and it's going to be the PDF is going to be usually the very first one you'll see, the very first result in the search here. And when in doubt, it's going to say a little PDF here. So you click through there, Earnings Insight by FactSet. And what FactSet does, it pulls all the analysts. It pulls analysts on Wall Street for their earnings expectations for companies in the S&P 500. It pulls them by sector, so it covers all 11 sectors in the economy, and really breaks down where earnings are going for these companies and for these sectors. And why that's important is because, sure, in the short term, month to month, even in a particular year, market sentiment and investor sentiment, how investors feel about stocks, how much they're willing to pay for stocks, is hugely important. I mean, that's the number one driver of short-term prices in stocks is, whether investors are happy, they're optimistic, they're paying more for stocks, or whether maybe they're getting a little bit fearful and, worried about where the market is going, so they're pulling money back. Over the longer term, though, it's all about earnings. Okay, earnings are what the profits a company makes, and that's basically at its core, that's what stocks are, is an ownership of those earnings. So you've got to be watching the earnings. You've got to be watching the trend in those earnings, and this is probably the single best research tool you can use is this biweekly FactSet report. So actually, we're going to scroll through, and there's some great charts here. I'm not going to cover all these this week or any of them really, just the one this week. I'm actually going to do next Sunday's live stream is going to be on the 7 different charts that I would follow in this. But this week, they published one of my favorite charts that I want to cover, and so we're going to make it all about this one this week. And let me just increase this one, make sure you can see it on the screen there. Okay, so what this shows you here is the the S&P 500 sector level bottom up target price versus closing price. Okay, and what this is again, they're surveying all of the analysts with their bottom up target prices, right? Their company level target prices for each company, each stock within each of these 11 sectors. Okay, and you see them across the bottom here: info technology, healthcare, consumer discretionary. All the stocks within each of those sectors, they're surveying analysts for their 1 year price target on those versus the current price in the market, and that's gives you a price return, right? An expected return on that sector. Right, so this is a great starting point for seeing what analysts are expecting in the market as far as sector level returns. And it's really beyond just investing in these sectors or looking within these sectors. So for example, here I see analysts expect the information technology sector, right? This very first bar here on the left, to produce about a 17.8% return over the next year, right? The highest of any of the sectors out there. So obviously, if I believe in that narrative, and we're going to talk about working with that narrative and what you agree with and what you don't, but if I believe in that narrative, then basically I've just eliminated 10 other sectors, which maybe 70-80% of the rest of the market. I can go straight to information technology, maybe look in the XLK fund, maybe look in the Triple Q fund for those IT stocks, and then I'm going to start my research for those best of breed stocks within each industry in that sector. So it's a great starting point, a great way to to just really narrow down your stock research, so you don't have to you don't have to find one stock out of the 5,000 in the market, okay? And what we see here, when we look over this iteration, right, this last 2 weeks here, they've got so information technologies first, healthcare they expect about 17% return, consumer discretionary is next, about a 15% return, communication services, which are going to be a lot of your tech stocks, your telecom stocks, are a 13.7% return. consumer staples, people need to buy. So like food packaging, household goods, that's 13.2%. Right here in the middle, about 12.7% expected return over the next year is the S&P 500. So analysts expect the broader market, now understand this is the S&P 500, so it's a little bit broader, a little bit more diversified in these sectors than maybe the NASDAQ, okay? And we're going to be talking about that in a little bit, how the difference there in the tech-heavy NASDAQ. So the NASDAQ really, it really includes more tech stocks. It's much more tech-focused, biotech, information technology, that kind of thing, than the S&P 500, which has a lot of these other sectors. Carrying on here, though, the utility companies, so those energy and electricity companies that you have, analysts expect 12.6% return from those. Real estate, 11.1%. Materials, and then you've got materials, industrials, financials, and energy clear over on the right here. Really the sectors that have outperformed over the last few months. Analysts, looking at their bottom-up price targets for these companies and where they're at now, they don't see a whole lot of return left over. So materials and industrials, about 6% return. Financials and energy down to 2% and 0.5% return left for the rest of the year. So it's really kind of an interesting change because just October, November of last year, then what you saw was almost completely opposite of this chart. Okay, it was almost completely switched, left to right. Right, what we saw in October, November last year, then analysts expected the financials, the energy, and materials to do much better. Right, those were all on the left side of the chart here. Analysts were expecting, in fact, I think they were expecting something like 30 or 40% return from the energy stocks, from the stocks in that energy sector. And what we've seen here is that because the energy and financial sectors have done so well, we can go back to, the sector tracker. And again, this is another one of my favorite tools to use. In fact, I use this every single day when I'm doing the daily Bowtie newsletter. I look at the sectors, how the sectors did that day, and I kind of try to find, what's the market saying about those stocks. And if we look at here, just over the last, we'll say 3 months here. So, and you can do 3 months, 6 months, a year, whatever. We've seen energy, 30% return on energy stocks. Financials, 22%. Okay, so what we've seen is, these energy and the financial stocks, the stocks in those sectors have already run so much further that analysts really, either they don't really see a lot more return from those stocks, from the stocks in that sector, or they just haven't updated their price targets yet. So that's some of it. We'll have to see here, especially as we get closer to the first quarter earnings releases, which start here in April. Okay, first quarter of the year is January, February, March. Companies start reporting that first quarter earnings in April, right? April, May, June, that kind of thing. So and as we get closer to there, analysts are going to start updating their price targets on a lot of stocks, and we'll have to see how this changes and what analysts expect out of stocks in these sectors. But basically, what they're saying is, so that's what they're saying with these four sectors right here: materials, industrials, financials, and energy. Analysts are saying that these sectors, these stocks in these sectors have run up so fast and so far over the last 3 months that there's not quite as much gas left in the tank. There's not much of a spread between the analyst price targets and where they're currently trading. On the other hand, they're saying over here on the left, these information technology stocks that have gotten just beaten silly over the last few weeks, there's much more of a spread there. Analysts are still clinging to those bottom-up price targets for those stocks, and it's about 17%, about 18% higher than where those stocks are trading at today. So really, it's kind of the analysts, I guess, have a narrative of kind of a rebalancing, I guess. And what I want to talk about here is not only what this tells you as far as, okay, so if you believe this narrative, if you just want to follow an analyst in general on average, then you would go and you would invest in information technology, maybe some healthcare, some consumer discretionary stocks, right? And you would avoid maybe lighten up on some of your energy, your financials, and industrials. Also, though, what you want to use this for is just creating your own narrative, your own story, right? Because that is so important when you're investing in the stock market. What is the narrative that the stock market is talking about right now? Where might it go in the future? Okay, because we know that the stock market is forward-looking. Okay, as investors and the collective wisdom of the market is trying to look out 6 months, even a year out in the future, and saying, okay, what's the market going to be worried about? Where's the economy going to be at in that 6 months or in that year? And they're going to start pricing for that right now. Okay, we're going to talk about that in a little bit with, kind of where the market and where the economy is now. But it's what we've seen in the last 2 months, right? The market has been very worried about higher interest rates, about maybe the Fed pulling back on some of that stimulus that it's put through because interest rates are rising. And that's hurt a lot of these information technology stocks, consumer discretionary, communication services stocks, okay? So this is very important in seeing, where the market is at as far as its narrative. And like we talked about, evidently the narrative from this chart that we can get is that, analysts, and so the people that are, on CNBC and talking about stocks all day, they kind of see that information technology has fallen too far. They still think it's going to do well. You could kind of glean from this that analysts as a whole, don't expect interest rates to really go up that much more. Interest rates shot up 7% on Friday to 1.63% on the 10-year Treasury bond, which was really interesting because, a 7% move in Treasury bonds and the yield is huge. Okay, you rarely see that big of a move. And yet tech stocks didn't do too badly. Okay, the NASDAQ actually finished down just 0.6% on Friday, which, if you look about a week before, then Treasury rates had jumped about 4%. And that was one of the big sell-offs in the NASDAQ. NASDAQ fell like 2.4% on that day, just on a 4% move higher in yields. So what I kind of wonder about that is, is that story around higher interest rates being bad for tech, is that kind of winding down? Okay, so if interest rates jumped so much, but tech stocks didn't quite do that badly, is that story getting a little old, and is IT really going to be that receptive to rising rates in the future? So maybe rates will rise, but tech stocks and the NASDAQ don't do quite as badly as we've seen over the last couple of weeks. And so that's kind of what this chart is talking about. That's the narrative, the story that I get from this chart is that, analysts either don't see rates going up that much higher or that much faster, or they don't think it's going to be quite the problem for tech stocks as it has been over the past month or two. Okay, so they think tech stocks are going to outperform. They think communication services and consumer discretionary is going to outperform. Now that's probably kind of a combination there, especially the consumer discretionary. That's a combination of the higher rate story, right? Because a lot of the consumer discretionary, the communication services, they're very high PE stocks, right? The communication services, those growth stocks in internet, in social media, that kind of thing, they have very high PE values, high PE ratios. So the higher interest rates go, the less attractive those stocks look because all of their cash flows are out in the future. We kind of covered that last week in our live stream, how that PE ratio and the interest rates kind of hold that relationship and why tech stocks have been falling over the past month. But again, if you don't believe that interest rates are going to rise that much, or if you don't believe it's going to be that much of a problem for these stocks, then again, those communication services stocks are gonna do better. They're going to rebound from what we've seen over the past month. The consumer discretionary stocks here, it's a little bit different story. They are some high PE stocks, so they have a little bit of that interest rate story built into them. But it's also, a fact that people are going to be getting out. They're going to be spending the money. Households in the U.S. have something like an estimated $2.5 trillion in excess savings, which that alone is close to, it's about 11% of the size of the economy. Size of the economy in the U.S. is about $22 trillion. So $2.5 trillion that could be coming into the economy spent on consumer goods, consumer discretionary goods, beyond just the $1,400 checks that are coming out, starting this week. So those are ones. The healthcare sector, which they expect is about 17% increase. That's a different picture right there. Healthcare, I've really liked healthcare over the last 3 months. It hasn't performed very well. So some of that is a value play. Some of it is also the biotech part of healthcare. If you look within that healthcare sector, some of the stocks have done very well, some of the industries, but you have a very big chunk of that is those biotech stocks, which kind of like tech stocks, they have higher PE ratios. So they've been hit by those higher those higher interest rates, right? Biotech, obviously, all the cash flow is out into the future. So when that's discounted on higher rates, then those stocks look less attractive. They're less highly valued. So that's kind of those top four. The consumer staples, 13% expected return. It's kind of surprising, but again, I think that's a lot of that is, and you see these next three: consumer staples, utilities, and real estate. All three of those are really yield sensitive sectors. Okay, so what happens there is, all three of these sectors: consumer staples, which the things you got to buy, the food products, the household goods; utilities, the things that electricity, we got to have lights, right? And then real estate. All three of those are very much cash flow yield. Okay, you don't get a huge return on price appreciation on those stocks. Most of your return is in those dividends and those cash yields, right? So what happens though is if those, if those we'll say those pay a 2% dividend yield, right? Well, if interest rates go up on bonds, if interest rates go up from 1% to 3% on bonds, then bonds are all of a sudden looking very attractive compared to those yielding stocks, right? So a lot of times when interest rates go up, you'll see investors come out of the consumer staples, the utility sectors, the real estate sectors, because there's just better opportunities. Okay, so those sectors get hit. And again, this really plays into the theme that I think this chart and the analysts are trying to say is that they don't think interest rates are really going to rise that much more or that quickly. And and they don't think it's going to hurt a lot of these sectors. So we'll see. We're really seeing a reversal of what we've seen over the last month or two, where interest rates have risen. They've hit a lot of these yield sensitive sectors, a lot of these growth sectors, and they've benefited from a lot of the reflation trade sectors, the materials, industrials, financials, and energy. Now you have to ask yourself, do you agree with this narrative? And that's very important. Because personally I don't, I don't agree with this narrative. And so, from my perspective, I think there's still more to play in those reflation and cyclical trade sectors. Okay, in energy, financials, industrials, materials. I think, yes, energy has come up quite a bit, and I think that's a little bit more limited than some of these other sectors. But I would be putting my money on these. And we're going to talk about just some of the research and some of the reasons why I think this is true right now. But so one, and just before we kick it over to a question and answer here, I want to cover something that I'll be talking about in the Daily Bowtie tonight. Actually, when that goes out to 9:00 tonight, the very first article is really interesting. It's some research by Ned Davis Research that just got published this week. And Ned Davis is a huge research firm. If any of you've seen the chart where how much dividend stocks beat non-paying dividend stocks and dividend stocks that increase their dividends versus ones that hold them steady or non-paying dividend stocks, that's that firm. So they're widely popular as a research firm. Put out a research article this week that said if interest rates on the 10-year Treasury, right, if interest rates rise to 2%, so again, changed Friday, closed at 1.63% on the 10-year Treasury. They're saying if interest rates rise to 2% by this year, which they think it will, and I personally think it will also, then tech stocks, the NASDAQ, could fall 20%. Okay, and how they estimated this was just on a kind of comparative bond yields, right? They're saying that if the 10-year Treasury rises to 2%, obviously that pushes up interest rates across the board for different types of bonds, for junk bonds, for corporate safe bonds, all interest rates get pushed up. Well, they're estimating that 2% 10-year Treasury is going to equate to about a 4.5% yield on high risk bonds, right? Junk bonds, non-investment grade, whatever you want to call them. And for that, for tech stocks, for the valuation in tech stocks and the NASDAQ index particularly, for that to be competitive with that rate, stocks in that index would have to come down by 20%. Okay, so that was just an eye opener for me. That kind of research, and that kind of quantitative research from a firm like Ned Davis. Now, whether you believe that, obviously, I think, a lot of the analysts polled here by FactSet would say they don't believe that. Either they don't believe that interest rates will go to 2% this year, or they don't believe it'll hit tech stocks quite that much. But, I'm more inclined to listen to Ned Davis or the research firm. But even if you don't, even if you believe, okay, maybe they're way off, maybe tech stocks, maybe the NASDAQ only comes down by maybe 10%, right? The NASDAQ index, which again, that's that group of tech stocks. It's more heavily focused on tech than say the Dow Industrials Index or the S&P 500, right? So if the Nasdaq came down, is down 10% from its peak this last week, right? It entered that correction territory, as we say. It was down 10% from its recent peak in January, right? And even and a lot of tech investors were just screaming bloody murder. They thought this was the worst crash since the Great Depression, right? Because a lot of those high beta stocks were down 20, 30, 40% or more. Just look in your portfolio. A lot of those very high beta, those growth stocks that you're investing in are down 30 or 40% when the overall market is only down maybe 10%, the overall tech index, right? So, and the NASDAQ has clawed back a lot of those losses. It's now down, I think, maybe about 5.5% since its peak. Okay, so what we're saying here is that even if Ned Davis is way off on its estimate and tech stocks only come down 10%, then you're still talking about another 20 or 30% on a lot of those tech stocks, right? Because those high beta names that tend to move more, more when the market moves. So I think it's very important research and very important idea to think, okay, one, do you think interest rates are going up? Which, I mean, it's hard to argue that interest rates are not going to go up throughout the rest of the year. Okay, we've got that $1.9 trillion stimulus coming out. Checks, 405 billion of it is in checks, is in stimulus checks. We've already had something like $2 trillion in stimulus pumped into the system from the government. We've got we've already had about 7 trillion or about 4 or 5 trillion from the Federal Reserve pumped into the system. So you cannot have upwards of, I think it's about $7 trillion. So we're talking about 30% of the size of the economy pumped into the system and not get higher interest rates, right? We've already seen that over the past 2 months. Okay, interest rates started the year at about 0.94% on that 10-year Treasury. They're up now to 1.63%. Right, so I think they get there by June. Really, I think they get up to 2% by June. We start seeing that higher inflation. It's going to spook the market and cause interest rates to go higher. So, the question is whether you believe that interest rates are going to go up, and do you think it's still going to hit some of these tech sector stocks, these growth stocks, communication services, consumer discretionary, that kind of thing. So it's really important to be able to look at charts like this and see that market narrative, and then find out or figure out what you think about it. Where you think that market narrative is going to go, and what you think is really going to happen. So I want to kick this over to question and answer, and and if I didn't see your question again, please ask it in the chat, as well as make sure you use a question mark so I can see that it is a question. And my scrolling isn't quite working here, so I don't know why that's not working. But I want to cover real quick just kind of a market update, economic update. Every week I see I see some organization upgrading its estimates for U.S. growth, right, and global economic growth. Just this last week I saw. I think it was the OECD upgraded U.S. growth to 6.5%. Okay, 6.5% growth. And to put that into perspective, like I said, the U.S. economy is about $22 trillion. 6.5% is like adding $1.5 trillion into the economy in that year. Okay, so so that's one of the reasons why I just don't see stocks crashing this year, okay? And we're not talking about the tech stocks. We're not talking about those growth stocks that are coming down 20 or 30%. But we're talking about the broader general market, the S&P 500, a lot of these other sectors that you're following. And it just isn't going to happen, okay? And in fact, in that research by Ned Davis Research, then they did say that 2 other indicators, valuation indicators that they're following for the market, do show that